Welcome, everyone. I'm excited to have you here today. We're about to dive into a powerful topic: master your mindset, master your trading. On this journey, we'll explore 5 key rules that can transform your trading mindset and help you achieve consistent profitability. We'll also uncover the hidden key to success: trading psychology. So stay with me as we unlock the secrets to a winning trading mindset. Let's get started. Trading psychology is such a crucial part of our success, and I want to emphasize that the market doesn't care about how we feel. It's completely indifferent. That's why it's so important to always follow your setup, regardless of your emotions. When traders get emotional, they often ignore their rules and proper risk management, which can lead to costly mistakes. Common emotional pitfalls include overconfidence, greed, and fear. Overconfidence can make us overtrade or take on too much risk because we believe we're invincible. Greed, on the other hand, can prevent us from entering trades at the right moments, causing missed opportunities or poor entries. And then there's fear, which can be just as destructive, making us hesitate or exit trades prematurely. All these emotions, fear, greed, overconfidence, they silently sabotage our trades before we even realize it. That's a key point. Most traders don't lose money because of a bad strategy. They lose money because of their mindset, their emotional reactions. So understanding and controlling these emotions is absolutely essential. It's about managing yourself first, because that's what ultimately determines whether you succeed or fail in trading. Let's talk about trading psychology here. The key takeaway is to always wait for confirmation before making a move. Don't assume the market will do what you hope or fear it will do. Many traders fall into the trap of entering trades based on emotions rather than logic. But remember, the market doesn't care about how you feel. It's crucial to follow your setup objectively. If you don't have a clear setup, it's better to stay out of the trade altogether. Patience is essential. Wait for confirmation and don't jump in prematurely. This disciplined approach helps you trade based on what you see, not what you feel. Remember, trading based on hope or fear often leads to inconsistent results. So always stick to your setup and follow it diligently. This mindset keeps emotions out of your decision-making and improves your overall trading performance. Let's talk about trading psychology, which is a crucial part of successful trading. One of the key takeaways here is that professional traders don't avoid losses entirely. They know how to manage them. The important thing is setting a stop loss before you even enter a trade, not after. This helps you control risk and stay disciplined. Accepting losses as part of trading is essential. No trader wins every time, and understanding this helps prevent emotional reactions. Proper risk management means having a predefined stop loss in place, so you're not making impulsive decisions when the market moves against you. Discipline is the foundation of professional management. It's tempting to think, one more trade will recover my losses, but this often leads to adding to losing positions and ignoring your stop-loss levels. That's where emotional decision-making kicks in, and it can be dangerous. Revenge trading is one of the biggest traps out there. Many traders fall into the mindset of trying to make up for losses by entering more trades thinking, if I enter one more trade, I'll recover. But this is a false belief and can escalate losses quickly. The key rule here is simple. Accept that losses are part of the game. You won't win every trade, and that's okay. Recognizing this helps you stay focused and disciplined, which ultimately leads to better trading over the long run. Now let's talk about trading psychology, which is a crucial part of consistent success. One key point is to risk only about 1 to 2% of your capital on each trade. Why? Because this helps you stay emotionally stable, even when the market moves against you. Proper position control is essential. Many traders make the mistake of taking on too large positions. When your position size is too big, even small market movements can trigger panic or impulsive decisions. This often leads to emotional reactions, like closing a trade too early or holding on too long, both of which can cause losses. Think about it this way. Most traders don't fail because they pick the wrong direction. They fail because they overestimate their position size and let emotions take over. When the lot size is oversized, Even minimal fluctuations can feel like a disaster, causing unnecessary stress. So the core message here is that controlling your position size is vital. Rule number 3 is to always manage how big your trades are. By risking only 1 to 2% of your capital on each trade, you maintain control, reduce emotional reactions, and stay focused on your trading plan. Remember, it's not just about being right on your trades, it's about managing your risk and your mindset to stay in the game long term. Let's talk about trading psychology, which is absolutely crucial for consistent success. The golden rule here is that if your mind isn't stable, your trading won't be stable either. When emotions take over, it leads to taking quick, impulsive positions that aren't well thought out. Impulsive entries can be costly and often result from trying to chase the market or feeling anxious to get in on a move. Breaking your position size or stop-loss rules is another common mistake. These rules are in place to protect you, and ignoring them can turn small losses into big ones. Similarly, ignoring your overall trading rules and entering too many trades without a clear strategy can cause chaos and erode your discipline. Overtrading is a big issue. It's a sign that emotions are driving your decisions rather than logic. Now, what happens when you trade emotionally? Well, there are several consequences. For example, excitement can impair your analytical thinking, making it harder to see the full picture. Stress reduces your ability to make clear decisions, and sleepiness can even lead to revenge trading, where you try to recover losses impulsively. Anger is another emotional state that can cloud judgment and lead to poor choices. The key point here is that emotional states, excitement, stress, sleepiness, anger, are all destructive. That's why rule number 4 is so important. Never trade under emotional pressure. Keeping a clear, calm mind is essential for making rational, disciplined decisions. If you let emotions drive your trades, you're setting yourself up for unnecessary risk and setbacks. Let's talk about trading psychology. One of the most powerful tools you have is becoming aware of your psychological patterns. Within just 30 days, you'll start to see clear patterns emerge in how you think and react during trades. This awareness helps you identify discipline violations, those moments when you might have broken your own rules. Recognizing what rules you broke is crucial because it shows you where you can improve. Another key aspect is capturing your emotions during each trade. Ask yourself, what did I feel at that moment? Were you anxious, confident, frustrated? Understanding your emotional responses helps you manage them better. Also, it's important to record your exit strategies, why you decided to get out of a trade. Was it based on your plan or emotions? Documenting why you exited can reveal if emotions influenced your decision or if it was a rational move. Similarly, note your entry setup and the rationale behind it, why you entered that trade. This reflection ensures you're sticking to your plan and helps reinforce good habits. This entire process is your secret weapon for consistent trading success. The more consistently you write down after every trade, the more you'll internalize your patterns and improve your discipline. Remember Rule 5, keep a trading journal. It might seem simple, but it's one of the most effective ways to develop self-awareness and discipline, which are critical for long-term success in trading. Trading psychology is a crucial aspect of consistent success in trading. While strategies and indicators might evolve over time, your mindset is what truly determines whether you become a winner or a loser. It's essential to avoid trading when you're under emotional pressure because impulsive decisions often lead to mistakes. Instead, trade only when your mind is stable and focused. Managing your risk is equally important. Limiting yourself to just 1 to 2% of your capital per trade helps protect your account from big losses. Controlling your position size is part of that discipline, ensuring you're not overexposing yourself. Remember, losses are part of the game. It's vital to accept them and manage them properly rather than trying to avoid them altogether. Following your setup consistently, rather than reacting emotionally, keeps you disciplined. Always see what's actually there, the market's data, rather than being influenced by what you feel or hope. This mental discipline is something you need to practice every single day because trading psychology isn't a one-time lesson. It's an ongoing process. So the key takeaway is that your mindset is the foundation of your trading success. Developing mental resilience and discipline will serve you much better than any indicator or strategy. Keep working on your psychology daily, and you'll build the habits that lead to consistent, rational trading.